Hey guys, what's going on? I'm back, and in this video we're going to be talking all about ROP Technologies. Now, I talked a little bit about ROP Technologies in part 1 of my Your Stock Picks for July 2018. However, I think it's a really great stock and I wanted to go a little bit more in depth and talk about it over a full analysis. As per usual in my analysis videos, we're going to start off with a brief overview of the company, followed by investigating the economic moat of that company. Then we're going to talk about the ROIC, the debt levels, the growth of sales, earnings per share, equity and free cash flow. Then we're going to check out what return we can expect to get using the value matrix. And lastly, we're going to come up with a buy decision and calculate what the fair value is and how much we should be willing to pay for ROP Technologies. Since I posted that 2-part stock picks video for July 2018, I have had a lot of requests for videos to be analyzed and just different types of videos. So don't worry, they're all in a list and I'm doing my best to cover them all, especially in this month, as I'm going to be posting a lot of extra content throughout the month of July. A number of people asked about my spreadsheet and whether they could get a copy of it, and very early on in this channel I actually gave it out to a couple people that emailed me and asked me for it, and I just thought, you know what, I'm just going to send it out to them. However, at the moment I'm currently working with a couple people to make it really user-friendly and sort of build it out so that it's more of a platform rather than just a made up spreadsheet that I've done in my spare time. And there will be a way for you to access that in the near future, and I may also just post a video on how to make certain components of the spreadsheet, such as the value matrix. And if you're interested, I do have a video already out on how to make the growth table to calculate the growth of a company over time. If you're new around here and you are enjoying the content, consider becoming a subscriber. I try to provide the maximum value I can, and if you even want some individual help, you can click the first link in the description below and it will take you to my Facebook chat, and I'm happy to answer any questions you have, and I'm usually very responsive on there, usually within the first 24 hours or even within the first couple hours if I'm already on Facebook. So what is ROP Technologies? Essentially, they are a diversified technologies company who specialize in the design and development of software for niche end markets. While the huge number of subsidiaries within ROPA mean that its revenues and profits are well diversified, it's going to be very difficult for anyone to completely understand the business because there are just so many different technological components. This is a key part of stock analysis because you shouldn't be investing in companies unless you completely understand how they operate. This is why Buffett invests in businesses with really simple business models, such as Coca-Cola. Now let's discuss if ROPA has a sustainable competitive advantage, which is essential in ensuring that our growth predictions are accurate. I usually look for companies that have a really obvious moat, such as in the form of a brand or a strong networking effect. However, if a company doesn't have an obvious economic moat, such as ROPA Technologies, I like to look at how the net margin changes over time. If the margin is growing, it indicates that a company is able to fend off its competition. However, if this margin is being squeezed over time, it can suggest that there are increased costs associated with generating new revenue. Of course, at this stage, we are just hypothesizing. We need to see strong and consistent growth numbers over a 10-year period before we can confirm that this company has a wide economic moat. Next, we have the return on invested capital, and this tells us how effective is management at investing within the company. It also provides further evidence of a competitive advantage because if the ROIC is growing over time, it means that a company is getting better returns on their investments over time. As you can see, the 5-year ROIC is 9.3%, which is just under our minimum requirement of 10%, and the 1-year ROIC is 10.12%, which is just above our 10% minimum requirement, and it's also above the 5-year ROIC. Now we want to make sure that ROPA doesn't have any out-of-control debt obligations, and if you don't understand why debt is so important, here's why. When a company needs more capital, it can choose between taking on debt from creditors or issuing more shares to shareholders. Creditors will usually demand a lower return on investment than shareholders, which means that debt is often cheaper than issuing more shares, which is the reason why businesses take on so much debt. However, creditors always get paid first, and then whatever is left over is given to the shareholders, and that's known as the residual claim. So the more debt that a company has, the higher risk to the shareholders. And if you're interested in corporate finance, we call this financing risk. More debt equals a higher financing risk. The ratios that I use to assess the debt are the current ratio and the debt to equity ratio. For ROPA, we can have a look at their current assets and we can see that they have 1.75 billion. They have current liabilities of 2 billion, which gives them a current ratio of 0.87, which is just a little bit too low for my liking. I like to see 2 or above. Next, we can look at the total debt or the total liabilities for ROPA, and we can see that they have 7.4 billion and they have equity of 6.8 billion, which gives them a debt to equity ratio of 1.09, which is a little bit high for my liking. I like to see below 0.5. The ratios tell us that there is a higher finance risk within ROPA than we would like, so we should be demanding a higher rate of return to make up for that extra risk that we will be taking on. So that brings us to the growth numbers, where we can see the core performance of ROPA over the last 10 years, and we can confirm that economic moat. A quick reminder for what we're looking for. We're looking for growth in the areas of sales, earnings per share, equity, and free cash flow. Over a 10-year period, we want this growth number for each of these to be above 10%, and then we want the shorter term growth rates between 7, 5, 3, and 1 years to be higher than the long term so that it's trending upward. If the long-term growth for these numbers is over 10% and over time these growth numbers are growing, it means that we can be confident in using those long-term growth numbers in predicting growth for the next 10 years. Having a look at these growth numbers, we can see that they are exceptional. In terms of sales, we've got 8% over the long term, which is just below our 10% requirement. However, as you can see, over the 7, 5, 3, and 1 years, it's always been improving, and this year they had a huge sales growth of almost 22%. Earnings per share long-term growth has been over 10%, 13.27, and each year it's been improving besides that 7-year average. This year they were able to grow EPS by a whopping 46%, which is insane. Equity is a very similar story, 14.66% long-term and growing each and every year. And for free cash flow, 12.59% over the long term and growing each and every year with a huge 27% growth this year. Finally, let's look at the value matrix and at what price we should be willing to buy ROPA. The value matrix tells us what returns we can expect to get if buying ROPA at the current stock price. So first we have to input a couple of details, which is the trailing 12-month EPS, which is $9.88. The time frame, we're looking over a 10-year period, and the current price as of recording this is $272.94. In the bottom table, we can see what the expected stock prices are to be in 10 years' time, and they range from $293 all the way up to almost $2,000 per share. And in the top table, we can see what return we expect to get each year over those 10 years, depending on the performance of the stock and the PE ratio of the stock in 10 years' time. For ROPA Technology, we can see that if they have growth of 3% and a PE of 22, you will get a return of 0.71 per year for 10 years, which is really low, but at least it's not negative for a worst case scenario. And in the best case scenario, if they grew at 18% or just over 18% per year for 10 years and they had a PE of 38, you would earn a return of 22% per year for 10 years, which is about 8 times your money. Finally, let's do a valuation of ROPA and see what the fair value of ROPA is and at what price we should be willing to pay. For this, I used a growth estimate of 12.13% over the next 10 years, so each year over the next 10 years, and I also predict that the PE ratio for ROPA will be about 27 in 10 years' time. And this allows me to predict what the fair value of a stock is and then able to discount that down and calculate what price we should be willing to pay. So similarly, we need to input a couple of data points. We need the trailing 12-month EPS, which is 9.88. We need the time frame, which is still 10 years. We need the margin of safety, which is the buffer we're going to allow for error in our valuation, which is going to be 50%. And lastly, we're going to need what return we want to get each and every year for 10 years. And the standard one that I use is 15%. Using my spreadsheet, I came up with an estimated growth rate over the next 10 years of 12.13%. And that gives us a fair value for ROPA Technology at about $207, meaning that it would be a buy at $103. Considering the stock price is currently almost $300 per share, the decision is a sell or an overvalued stock. As an interesting experiment, if we drop our margin of safety to 15% and we drop our required return to 10%, just over the market average, ROPA Technology does become a buy. However, I will caution you with dropping that margin of safety below 50% because we are going to be wrong in our valuations at time to time, and we want to ensure that we get the returns that we want. So that's all from me today. I hope you enjoyed this one, and if you did, make sure you show me some support by hitting the like button and subscribing below if you haven't already. These videos are by far my favorite to make, however they take a lot of time and effort to put together, so I really appreciate all the support. I want to try and get this channel to 500 subscribers before the end of July, so I'm going to be bringing out 10 new videos this month, including videos analyzing ASX stocks and an update on my how to analyze a stock video, so stay tuned. I hope you guys have an awesome day, but for now, I'll see you guys in the next one.